that flows into the over-the-counter spot markets that is not NSFR compliant, EFP gold flowing out of the COMEX must be Basel III compliant. Now,
that's absolutely amazing, Andrew. Now, silver is not part of Basel III, and they're not Basel III compliant. So how does this actually affect gold now?
Yeah, to provide context into the joined at the hip gold market, unlike this EFP, and remember EFP is simply the transit of a COMEX position into the over-the-counter markets for either settlement or arbitrage reasons or for delivery. But unlike the EFP COMEX silver that flows into the over-the-counter spot markets that is not NSFR compliant, EFP gold flowing out of the COMEX must be Basel III compliant. Now, obviously, we've talked about how some of it's flywheeled into the GLD ETF and stays as an unallocated. But with people so bearish about gold, no one wants GLD. It's unloading. So therefore, obviously, these flows, so GLD aside, these flows touch the local London trading and clearing process. And because this is not the case in the non-NSFR compliant EFP paper-to-paper over-the-counter settled silver markets, as a result, they have now been rendered redundant, completely redundant as a working hedging instrument. And therein lays the COMEX Achilles heel. This poses a problem never before experienced by the CME COMEX ringmasters. A full inventory loadout. Now, look, loadout is simply the term applied to silver or gold actually physically exiting the warehouse versus just being delivered across the blue warehouse sender line. When I say delivered, I mean shuffled. So this loadout of COMEX registered silver stocks is about to seriously threaten the related but corralled eligible category of silver inventories in the warehouse, which are not deliverable because they're not registered for delivery. So I think COMEX stored inventories, which so far, by way of sleight of hand, insider warrant shuffling about these positions, has so far, none of this has exited the COMEX warehouses. But it is eligible. And the prices say, come after me. Well, why wouldn't you deliver me if I'm offering to buy you? So backwardations tell us that this warrant shuffling has caught up with the ringmasters, causing the price to fully disconnect from the global physical markets because they're trying to block this happening. And unless the CME steps in to restore this COMEX as a legitimate hedging facility, loadout on an industrial scale will occur. And this is not a Hunt Brothers-like situation where the CME can call in their margin. This is fully paid up global physical market trying to source available silver stocks to fill orders at deeply undervalued prices. It's something, sometimes forgotten that the primary rationale for the existence of a regulated gold and silver futures market is to provide a legitimate hedging mechanism for a range of, market participants. We've talked about this, if you're a physical holder, you may need to hedge some of it. A long spot, they have a long spot or forward contract. Look, which refiners and producers rely on. You need to have a hedging instrument to protect that, which, obviously they're relied on, but ultimately lead into this multi-billion-dollar derivative bets. And obviously, we're also talking about this also leads into the OCC and the multi-billion-dollar derivative bets, which are listed there, but actually don't even encompass the 14-day forwards that are perpetually rolled over. We've talked about this many, many times. And even went to London, to the UK Parliament, and met with Andrew Bailey to discuss this issue. Now, while the industry understands the implications of this complete futures market collapse and are positioning for an inevitable physically deliverable silver shortage by, guess what, loading up on physical for their own books, at the expense of, but very importantly, limited to, these clueless, the ability of these clueless COMEX siloed blinkered specs currently tricked into chasing a dot on a screen to a potential zero, which obviously can't happen, but in their minds, it can. These specs are being led like lambs to the slaughter. And following the full June 2020 chart gap close we just referred to, there are very few, if any, paper longs left to rinse. Therefore, margin calls will be called in on the shorts. And this is potentially a Hunt brothers in reverse. This time, the global markets calling in the casino's margin.
Now, Andrew, our community members will know that if they look back over the last several months, you've been talking about nickel. You keep on bringing up nickel, and it blew up and it blew up. Can you talk just now to our members about the similarities between what you saw in nickel, what you've been talking about in nickel, and what's happening in silver right now?
Yeah, Shane, the all-important margined silver market liquidity is being crystallized and flowing out of the COMEX backdoor into deliverable physical exchanges outside the breached CME LBMA ring fence. We kind of talked about it last time a little bit, but it's this enormous evaporation of liquidity in the price-setting COMEX markets that's causing this historically unprecedented disconnect. And with the global market liquidity slowly now returning after the holiday break, these same sharks that fed on the broken nickel market will smell blood in the water. Now, drawing unwanted attention to this risk-free arbitrage opportunity is our objective, but it requires some very deep pockets. Now, if you have deep pockets, suss out the risk-free instant arbitrage profits now. But let's not forget what caused, as you say, this nickel market to blow up. It was the chain reaction to a sudden shortage of physical versus what was sold short in the undeliverable paper markets. Hey, does that sort of rhyme like something? I mean, while the LME was able to ring fence the nickel blow up, leading to yet unresolved multi-million-dollar lawsuits against them, let's make it absolutely clear, it is not possible to ring fence a similar derivative blow up in a globally traded foreign exchange cross, of which silver is one. Now, people forget that. Now, silver's daily foreign exchange fix reflects a web of interconnected, highly leveraged paper market inputs, which include short sold, borrowed, unallocated SLV, in other words, shorted SLV, which severely dilutes any real unleveraged physical supply demand inputs. So when you work out this fixed price, you've got all this stuff in there. And the relating fix has nothing to really do with real supply and demand, but nevertheless sets the global price of silver. So yet insiders are scrambling to use spec-driven sell-off to short cover what they can of these insanely leveraged derivative bets. But once liquidity returns during this month of September into the end of the third quarter, there is little doubt the sharks will circle. This is free money on a wholesale scale, and the only defense for the house to counter this risk-free arbitrage raid is for the commercials to begin to ring the register on the speculators that caused the disconnect to reach these historically unprecedented actionable levels. Now, the risk-free profits to be earned by loading out futures contracts are far too large not to attract a short squeeze. And while specs don't have the wherewithal to capitalize on this massive arbitrage profit, because they're not even allowed to trade in the over-the-counter markets, insiders do and are. And premiums over spot for retail coins sends out a smoke signal, but it's largely missed by the big ticket players. Drawing attention to this wholesale market opportunity is one of the objectives of bringing the scale of this trade to the attention of rich pools of predatory money. Yeah, much to the embarrassment of Jamie Dimon back in 2012, This same kind of agnostic these predatory sharks, completely agnostic to anything. They don't care about silver, don't care about gold, but they smell blood. And they attacked, if you remember, in 2012, Jamie Dimon's, JP Morgan, it was called the IG9 trade, and they fed off this bleeding whale to the tune of about over $6 billion of JP Morgan's money. Now the market, the naked short silver position is even more attractive, guys.